Okay, guys, welcome to today's session. This is MAC4861, MAC4862, and we'll be covering a big topic within management accounting, and that is cost volume profit, CVP. As you can understand, if you look at the name says CVP, cost volume profit. So all CVP is about is basically a sensitivity analysis. It helps you to identify certain points and so forth. So CVP analyzes costs, it analyzes volume, and it analyzes profit. Okay, so that is basically the whole purpose of CVP. The concepts of CVP is quite significant. You will always basically get it, whether it is a direct question, like in this question, they're directly asking you for something relating to CVP. But in other cases, especially a CTA 2 level, especially a board level, an ITC level, which is ultimately what you're going to write, they will test CVP whether it is asked directly or indirectly. Now, one of the main items, or one of there's quite a few formulas, right? But the common and most important ones is basically two types of formulas. Number one, it is contribution margin, and number two, it is break-even analysis. Now, the break-even is the typical question they will ask you. Contribution margin is tested throughout management accounting, so they are using things from CVP elsewhere as well. Okay, so just take note, the two big formulas when it comes to cost, volume, profit, contribution margin, and break-even. Tonight's question is about break-even. In order to calculate break-even, we're going to need to be able, we will have to calculate contribution margin as well. Then there are other formulas that is also tested in contribution margin, so I mean in CVP, and that is like margin of safety and all of those type of things. But that hardly, I mean, you can know it, but our main focus is going to be break-even analysis as well as contribution margin. So basically the main question they're going to ask you is break-even. Okay, and in order to get break-even, you need contribution margin, and contribution margin they test throughout in other topics as well. So just to understand, it is very important to distinguish contribution margin, gross profit, and the cost of a product. Okay, you must distinguish between what is contribution margin, what is gross profit, and what is the cost of a product. I remember I mentioned that it's important to distinguish between those three items. The reason being is many times we get confused in what relates to what. So what is a cost of a product? The cost of a product is basically which items makes up the cost of a product. Okay, and I remember, what makes up the cost of a product is only production costs. It is only manufacturing costs. Anything that forms part of the production process or the manufacturing process will be included in the cost of a product. The second thing to take note of is that the cost of a product depends on the costing system. If you are using the variable costing system, it will differ versus using the absorption costing system. Remember the thinking process as follows. If they say, dear student, please determine the cost of a product, then you need to tell yourself that the cost of a product is made up of three things: direct material, direct labor, and manufacturing overheads. Then you must tell yourself that manufacturing overheads is made up of two things: variable manufacturing overheads and fixed manufacturing overheads. Okay, but then remember, there's a difference in terms of absorption versus variable. Under the absorption costing system, you include fixed manufacturing overheads, whereas under the variable costing system or the direct costing system, you exclude fixed manufacturing overheads. Now contrast the cost of a product with contribution margin. What is contribution margin? Contribution margin is sales less total variable costs. Now that's very important. It is sales less total variable costs. So total variable cost is made up of variable manufacturing costs or variable production costs, same thing. And it is made up of variable non-manufacturing costs, variable non-production costs. An example of variable non-manufacturing, non-production costs is your variable selling costs. Okay, so just take note of that. Very, very important to distinguish those items. Then what is gross profit? Gross profit is sales less cost of sales. Remember, contribution margin and gross profit depends on the costing system. We use contribution margin. Contribution margin is based on the variable costing system, whereas gross profit is based on the absorption costing system. But please distinguish variable, please distinguish contribution margin versus gross profit versus cost of a product. Why do I say this? Because many times when we work out contribution margin and they give you different costs, you must know which one to include and which one to exclude. You must also know which one forms part of the cost of a product and which one does not, because that is what many students get confused about. So please make sure you can distinguish those items. Now we come to break even. Break even is an important number. So like I said, in ITC, they sometimes directly ask you for break even, or they ask you for it indirectly. A typical way of them asking it indirectly is they give you a question, generally like 20 to 30 marks, and they will say, dear student, please comment on the profitability of the company. Now, this is not financial management. If it was a financial management question, commenting on the profitability, would you be using ratios? But over here, it's management accounting. So you are assumed to be the management accountant, so you have a little bit more extra detail and so forth. So how do you comment on, So generally, they're going to give you a scenario where a company is perhaps struggling, they're making a loss, and you need to provide some insight as to how they can generate a profit. Now, one of the ways to actually see whether a company can become profitable is to perform a break-even analysis. So when you perform a break-even analysis, it tells you how many units the company need to sell in order to break even. Then you compare it with two things, okay? So now once you know how many units a company need in order to break even, you actually compare it with three things. You compare it with the current sales levels, okay? Then you can see that is a problem. But the other two things you need to compare it to is their production capacity and the market share. So for example, let's say they, in order to break even, they need to sell 900,000 units, but the production capacity is 1 million. As you can see, that is a very fine line. Okay, so in order to break even, you need to sell 900,000 units, yet your capacity is only 1 million. This company is not really going to make a good profit, because break even is way too close to total production or maximum production. So those type of things you want to compare. Similarly, you want to compare it to market share. So you might know the total market, and then we will have to find out what percentage of the market we have. So let's say again, production is at break even is 900, and they and then the total market is, let's say, 1.5 million. As you can see, they would need more than 50% of the market in order to break even. That tells you the company is not a viable company. Or in order to have 50%, more than 50% of market share, only then will you break even. It's not a viable company. They won't be able to turn a profit, because even the companies with the biggest market share don't even have 50%. You understand? Like if you look at industry analysis, then a big market share is like 10, 15, 20%. Now imagine you need 50%, more than 50% to break even. More than 50% of market share to break even. That tells you the company should just rather shut down, or they need to do something else in order to reduce the break-even numbers. So remember, so one of the ways is to increase your number of sales, number of units, or to increase selling price. Remember, in management accounting, when you think about management accounting, is all about the profit line item, operations, okay? So just to give you some context, management accounting is all about operations. There's 4 decisions. You have the financing decision, you have the investment decision, you have the operating decision, and you have the distribution decision. Distribution is like dividends and so forth. Now, investment decision, financing decision, and distribution decision falls within the domain of financial management. Operation decision, the operating decision, falls within management accounting. That's all about earning the profits. How do you earn profits? Sales less total costs. Now in management accounting, total cost is split into 2, fixed cost and variable cost. So basically profit is sales less variable costs less fixed costs. Now sales and variable costs can be split between units times for sales would be number of units multiplied by selling price. For variable cost, it will be number of units times variable cost per unit. Fixed cost is fixed cost. So if you analyze a company, if you reduce sales, automatically you reduce variable costs. If you increase sales, automatically you increase variable costs. Okay, that is why sales less variable costs. We look at the contribution margin for each additional unit that is sold, or for each additional unit that is lost, a contribution margin is earned or a contribution margin is lost. And that will impact how you cover your fixed costs, which ultimately will impact the profit that you earn. So if you see that picture, so when they ask you for profitability, you can either increase sales. You can increase sales in 2 ways, either increase the selling price or you increase the number of units. Now, this is where, in most cases, you can't increase the selling price. The fact that you're struggling probably means that you're in a market that is saturated. You're in a market that is highly competitive. So if you're in a competitive market, you can't play around with price. Okay, so that is effectively ruled out. So the only other thing you can do is increase market share, increase your number of sales. So that is where break even comes in. How many units do you have to sell in order to break even? You compare it with your current sales, you compare it with total production, you compare it with market share. So that is basically how you can comment on it. And then obviously the next aspect would be if you can increase contribution margin by reducing variable cost per unit, or if you can increase the number of break-even units by reducing fixed costs. So those are the type of comments that you must be able to handle. Now, we're going to deal with a break-even. What is the formula for break-even? Break-even is total fixed costs, the grand total of fixed costs, meaning manufacturing fixed costs as well as non-manufacturing fixed costs, total fixed costs, okay? Divided by contribution margin per unit. So please take note, the numerator fixed costs is a total level, whereas the denominator contribution margin is on a per unit level. Now remember, what is total cost? It is what is total fixed cost? It is manufacturing as well as non-manufacturing. Contribution margin, how do you calculate that? Sales minus total variable costs. Total variable costs includes manufacturing variable costs as well as non-manufacturing variable costs. Remember, the denominator needs to be on a per unit level. Now that is the formula, fixed costs divided by contribution margin per unit. However, that formula is only relevant, is only applicable if you have one product. For our purposes, from a third year level onwards, and obviously now certainly on a CTA level, you're not going to be given one product. You're going to be given more than one product, typically 2 to 3 products. So the contribution margin is not simply a contribution margin per unit, but rather it is a weighted contribution margin per unit. It is a weighted contribution margin per unit. The way you're going to get the weighted contribution margin per unit, you have to calculate the contribution margin for each product. So let's say 10 Rand, 20 Rand, 30 Rand. Okay. Product 1, 20 Rand, product 2, what did I say? Product 1, 10 Rand, product 2, 20 Rand, product 3, 30 Rand. That is contribution margin per unit. Then what do you do from there? You need to find its weighting. The way we work out its weighting is based on a sales mix. Okay, so they will give us a sales mix, or they will indirectly give us a sales mix. We'll be able to easily see the sales mix, so you don't have to stress about that. The sales mix, we just convert into a ratio, and then we use that ratio per product. And then we say contribution margin times our sales mix to get a weighted contribution. So that's how we're going to do it. Nothing complicated, but just take note. To work out a break even, it is fixed cost less divided by contribution margin per unit. But for our purposes, we use an adjusted formula, which is fixed cost divided by weighted contribution margin per unit. Okay, so now we're going to get into this scenario, and then we will go through some more discussion as we go along. So these questions tend to be quite a lot of marks, but if you keep your head straight and you keep your framework in mind, you can score good marks, like really good marks, if you keep your head straight. Okay, so we're going to try to keep that thinking going, and we're going to try to make sure that the framework is there, how to think through it. I just want to make something clear. Like I told you, that when they say, dear student, determine the cost of a product, we said there's 3 things: direct material, direct labor, manufacturing overheads. Manufacturing overheads is fixed and variable. So that's your thinking, that's your framework, but it does not mean information is always going to be given that way. Okay, so just be aware of that. You know, a cost of a product is made up of those 3, but they can give you information where it is only direct material and variable overheads. I mean, and manufacturing overheads and stuff like that. Or they combine direct material and direct labor. But what you must know, ultimately, fundamentally, it's making up those 3 items. So you must keep that in your mind, but before you write it down, you have to have a look what information is presented in the scenario that matches that. Okay, so please make sure it's not always going to be exactly that format, but when you look at it and you see, and you it's not even hard to look. If you just look at it and you understand what's making up, you will see it's made up of those 3 aspects. Okay, so I'm just going to share my screen. We're going to reread the scenario, but a lot quicker because we read it last time, so you can look at the details of reading it in the previous lesson. We're going to read through this a lot quicker. Okay, so this is the question we did last week where we covered ABC. Now we're going to cover part 1, which is CVP. So they say Steyn So the SSI is a large-scale manufacturer of household goods and furniture. 80% of SSI's revenue is derived from government contracts, and the remaining position consists of sales to private consumers. Teddy Great, company CEO, prides himself on extensive business network contacts, as can be seen from his Instagram profile, where he is regularly invited to high-profile parties and government functions. The Eagles, a specialized anti-corruption policing unit, were planning to raid the offices of SSI after receiving an anonymous tip-off. The administration building, which also housed the finance department for the SSI group in Braamfontein, burned down prior to the raid, destroying most of the accounting records and other documentation. SSI did not have any electronic backup of the data. Like I said, from a company law perspective, one of the sections of the Companies Act requires a company to maintain records of at least 5 years. Okay, so they actually have a responsibility to have ensured that they can maintain records for 5 years. Okay, so Smart Furniture Division. Smart Furniture is a division of SSI which sells designer couches to millennials with built-in electronics. Couch Charge, which is Charge C, is an entry-level product covered in premium material, which has built-in charging stations for cell phones. Smart C is the luxury option covered in A-grade, full-grain leather. In addition to Charge C functionalities, the Smart C also has Wi-Fi and Bluetooth speakers. Okay. SF's financial department was also based in the Braamfontein office and has lost most of its information and data. The accountant was preparing the 2020 budget based on 2019 actuals. Fortunately, the accountant emailed the 2019 actual financial profit statement to management the day before the fire as follows. Okay, so there we can see revenue, less cost of sales. Cost of sales is made up of production costs and closing inventory, which gives us gross profit. As I mentioned, the fact that we have cost of sales, the fact that it is gross profit, it's telling us that the company uses the absorption costing system. If we had variable cost and contribution margin, then it meant they were using the direct costing system. So just take note of that. This is meaning they're using the absorption costing system because we have gross profit. If it was, what was it now? If it was contribution margin, we're using the direct costing method. So here we have note 1, 2, 3, 4, and 5, and then we have charge C and smart C. Then they have less selling and administrative costs, and that gives us net profit before tax. So now we have the various notes. Note number 1, the budgeted sales units for 2020 will be the same as the actual sales in 2019, which were 243 units of Charge C and 129 units of Smart C. Sales prices are budgeted to increase in line with inflation. Okay, so remember, the budgeted sales for 2020 is equaling the actual sales of 2019. The actual sales of 2019 is 243 and 129. Okay, so now we know what is budgeted sales, and they're telling us that sales price are budgeted to increase in line with inflation. Note number 2, due to new production techniques expected to be implemented in the 2020 financial year, the variable cost of production will increase by 5%. Okay, so whatever the variable production cost is, it will increase by 5%. So as you can see, we'll have to have a look. Included in here would most likely be fixed costs. How do we know? Because they're using the absorption costing system. How do we know they're using the absorption costing system? Because we can see gross profit. When we see gross profit, when we see cost of sales, it means they are using the absorption costing system. When you are using the absorption costing system, it means the cost of a product is made up of direct material, direct labor, variable manufacturing overheads, and fixed manufacturing overheads. So remember, the absorption costing system includes fixed manufacturing overheads. Here they're telling us that the variable production cost will increase by 5%. They did not say the production cost. They said the variable production cost will increase by 5%. Now, there is direct material, direct labor, variable manufacturing overheads, fixed manufacturing overheads. So direct material, direct labor, and variable manufacturing overheads, those are considered variable costs, and only fixed manufacturing overheads is considered fixed. So therefore, this production cost of 3510 includes fixed manufacturing overheads. This production cost of 5063 includes fixed manufacturing overheads. So in order to get the variable production cost, we're going to have to find out what is the fixed manufacturing overheads and reduce this production cost by the fixed manufacturing overheads to get the variable production cost. Once we get the variable production cost, we can increase it by 5%. Okay, so just take note of that. Note number 3. The furniture division did not budget to have closing stock. However, they have experienced a decline in sales towards the end of the 2019 financial year. Subsequently, the closing inventory based on actual production was 10% for charge C and 14% for smart C. The division will amend the production schedule for 2020 so that no closing stock will be on hand if the budgeted sales materialize. So as you can see, this company don't keep opening and closing stock. So in 2019, they had no opening stock, but unfortunately, they ended up with with closing stock. And the reason for that is actual sales did not turn out to be equal to budgeted sales. Okay, so therefore we'll be able to work out, given that information, we will be able to work out the production, and as a result, we will be able to work out closing stock. Okay, so 2019's actual closing inventory becomes 2020's actual and budgeted opening inventory. And remember, because it's opening inventory, we know what our budgeted sales are. So we will be able to work out what our production schedule will look like, given the fact that we want 0 closing inventory. Okay, so we will play around with that, because we will need those information. So now they say fixed manufacturing overheads are currently allocated based on labor hours. Historically, the production process required 4 labor hours for charge C and 8 labor hours for smart C, calculated at 750 Rand per labor hour. Actual production quantity was equal to budgeted production quantity for 2019. Fixed manufacturing overheads is budgeted to increase by 8%. So remember, we said under the absorption cost, you have 2 costing systems. You have the variable costing system and you have the absorption costing system. Under the absorption costing system, there are 2 further elements to consider. So remember, absorption costing system includes fixed manufacturing overheads. So the fact that it includes fixed manufacturing overheads, we need a basis to allocate fixed manufacturing overheads. There are 2 approaches. So you have the absorption costing system, where fixed manufacturing overheads is allocated using the traditional costing method. And then you have absorption costing system, where fixed manufacturing overheads is allocated using ABC. Now, last week we dealt with it where it was using ABC. We also worked out what it was using the traditional costing method. The difference between ABC and the traditional costing method, the traditional costing method uses one basis of allocation, like in this case, labor hours, whereas ABC is based on actual activity that causes fixed that results that would have an impact on the cost of the fixed overhead. So just take note. They're saying selling and administration cost is estimated at 5% of revenue. Inflation is 6%. Okay. We're not going to read the new costing system. We used that for last week, so we'll go straight into part A. They say, calculate the budgeted number of couches for each type required to break even in the 2020 financial year based on the current allocation of overhead. So based on the current allocation of overhead, they're just telling you using the traditional costing method, not using ABC, because ABC is the new costing method. So they say, remember, like I said, there's always three things you must look at. When you're busy with costing, to help you navigate where in the scenario you need to be, look for three things based on the required. So number one is to have a look whether you need to use budgeted information or actual information. Number two, you look at the date, okay? And then number three, you look at the period. So a period means the month, the year, the quarter, the date, 2019, 2020, whatever, and budgeted versus actual. So here you can see, they say, calculate budgeted, okay? So you must use budgeted information. In the 2020 financial year, so for the full year of 2020, they could have asked just for January, just for May, whatever. That helps you to navigate where in the scenario to look, because most of the information will be under that. Fortunately over here, this is a short scenario, so everything is mixed up. But just have a look in a more complicated scenario, you will see they will have headings, right? And some headings will be relating to budgeted information just for the month. Then other information will relate to actual, and other information will be related to the next month or the next year, and so forth. So that helps you to zone in where to look. That does not mean they won't use information from other parts of the question, but basically 95% of the information will be under that question, under that section, if not 100% of the information. So use that as a gauge. Budgeted versus actual, the period, meaning 1 month, 1 year, 1 quarter, and then the date. Okay, so here you can see the date, 2020, period, financial year, for the full year, budgeted information. So we must use that information to do what? To calculate break even. Okay, so we must calculate break even. Calculate break even of what? Of the number of couches for each type. So that means for what now? For Smart C and what's the other one? Charge C. So they wanted per type. But remember, when you have more than one product, you're only going to get one break even, which is fixed costs divided by weighted contribution. That's going to give you the total contribution. Then we will have to then split it out between the two items. Okay, so if we have a look here for 2020, the sales mix, the budgeted sales mix, they never gave us a sales mix, but we can use what the budget, 243 and 129. I don't know what is that. 243. So the way you're going to work out your sales mix is as follows. I'm going to open up Google. Okay, but anyway, we'll get there when we get there. Okay, so I'm going to open up Google quickly so we can do the question. So remember, what do they want? Break even units of the couches. I was trying to open up Google quickly. While we're waiting, do you have any questions? And also, could you access the Google Drives. You should have access to it already. Anyone? If you did access it, can yeah. I just need to pause the recording quickly. Something just not right. I just need to get to Google quickly. Okay. So what was I saying? Okay. So what was I saying? So what I'm saying over here, I just need to discuss this orange quickly. So with the orange, remember last week we I lost my train of thought now. Okay, so with that orange, I see there was basically two ways you could have done it. So with ABC, your activity, the cost changes. The cost is increased or decreased based on the driver. The driver, the more the driver, the more cost you incur. The less the driver, the less cost you incur. That is what ABC is all about. Identifying the activity and then identifying the driver that causes that activity to either increase or decrease, and ultimately having an impact on the cost of that activity. Now, for this activity over here, order and delivery, the driver that increases or the driver that will either increase or decrease the cost is the number of client interactions. Now, for charge C, there were 3 interactions, 3 client interactions per unit, whereas for Smart C, there were 5 client interactions per unit. Now, I said, okay, only if you make a sale will you incur that cost, because if there's no sale, there's no client interaction. Okay, only if there is a sale, there's a client interaction. So I used my numbers based on sales units. Then I say there's another approach, which is we are working out the cost per unit for fixed overheads. We are working out the cost per unit, the fixed cost, the fixed manufacturing overhead cost per unit. Now you only have fixed manufacturing overheads based on units produced. So you could also be using units produced. Okay, so just take note of that. So let's just think about it. There are 2 ways. The one way is using units produced. Why does that make sense? It is because we are working out fixed costs per unit, fixed manufacturing costs per unit. You only incur fixed manufacturing costs in the production process. So therefore, you should be, it makes sense to use production units. Then I say there's another way where you can use sales units, because you only incur client interactions if you make a sale. If there's no sale, there's no client interaction, and so forth. So I used sales, but why I said I want to change it, because I wanted to mirror the solution. They use units produced. So all I'm going to do now, I'm going to change units produced. I'm going to change the number of units from sales units to units produced, just to get the same number. So when you compare this to the solution, there's no confusion. Okay, so just take note of that. If you don't understand, you can either contact me separately again, and if you still don't understand, just ignore and just use units produced. Okay. So I'm going to say budgeted units. So I'm going to copy that. So that would change, and that would just basically impact this thing. So now our numbers would basically be exactly the same. Okay, so our numbers would be, I kind of did a spot check last week sometime. So now our numbers will be exactly the same. Okay, so if you're confused, just rewatch this part of the video. And if you're still confused, you can contact me. And if you're still confused, just ignore and just follow. Okay, but try to make sense of it, why it makes sense. Okay. So now I'm going to go to required B, which is the part of this question, which is, dear student, please calculate budgeted break even. So when we calculate break even, what are we calculating? So break even is one of the formulas of CVP. Break even equals fixed costs divided by contribution margin per unit. Contribution margin per unit. But remember, that formula, fixed cost divided by contribution margin per unit, is only for one product. We have more than one product, so this contribution margin must change to weighted contribution margin per unit. So in order for us to get break even, we need fixed costs, and we need what we need, weighted contribution margin. Weighted contribution margin per unit, and this will give us break even. And now this is going to give us total break even. They never asked us for total break even. They asked us for break even per product. So now we'll have to split the break even between charge C and smart C. Okay, so there we have our things set up. Now we can do our workings. So you just do, that's how you work at break even. Okay, it's 18 marks, but basically it's going to come down to that. And now we're going to do the workings, and our workings will help us answer all of those questions. What am I looking for? So here we have workings. So we can start with anything, okay? Whether you want to start with fixed costs, or whether you want to start with weighted, whether you want to start with contribution margin. I just want to, so you can see me swapping between the various screens. Okay, so let's have a look. So remember, fixed manufacturing overheads are currently allocated based on labor hours. Historically, the production processed required 4 labor hours for charge C and 8 labor hours for smart C, calculated at 750 Rand per hour. Actual production quantity was equal to budgeted production quantity for 2019. Fixed manufacturing overheads is budgeted to increase by 8%. Now, what we must know is that we already calculated fixed manufacturing. We already calculated fixed overheads. Okay, so just so you know, so you can understand, we want total fixed overheads. Okay, so remember, we want total fixed overheads, and total fixed overhead is made up of fixed manufacturing overheads as well as fixed non-manufacturing overheads. In other words, it is manufacturing overheads that are fixed, and it is non-manufacturing overheads that are fixed. Now, there are no non-manufacturing overheads that are fixed. We only have fixed manufacturing overheads. Okay, I just wanted to give, so you can see the full picture. You must go through the scenario. In many times, you'll read IBAD 0.1, 0.2, 0.3. What you must, when it comes to costing, what you must try to be aware of is make a note somewhere, because remember, okay, you're writing online, so most of you probably read the scenario, read the required first. But next to each point, you must let yourself know whether there's a fixed cost or variable cost, or whether they are both, so you don't miss anything. Okay, so only point 4 dealt with fixed costs in this thing. So let me just show you quickly. If we have a look over here in point number 1, point number 1 is only dealing with units, okay, sales units. Point number 2 talks about variable production costs. Point number 3 talks about what? Number of units, opening, closing, and all of those type of stuff to help us get the number of units we need to budget, we need to produce in 2020. Point 4 deals with fixed manufacturing overhead. So we know that is fixed costs. Point 5 deals with selling and admin. It's not telling you whether it's fixed or variable. You need to figure out whether it's fixed or variable. This is variable. The reason being is they're telling you selling and admin is estimated at 5% of revenue. Whenever something is relative to revenue, you take it as variable, because fixed cost does not change relative to revenue, relative to output. Okay, then number 6, just inflation. So therefore, it's 100% clear that point 4 is the only one that relating to fixed costs. Now, I'm not going to go recalculate it, because we already calculated last week. So I'm just going to go fetch it from a required A, if I can find it. Fixed costs. Fixed costs. It is working 1. You can see how we got it. So I want to use working 1. Okay. So there we go. You can see how we calculated it. Okay. So you can figure that out. So total. So there's something I'm going to say from A. So remember, I obviously dealt with this question differently, because we started with B, is based on the syllabus. In the exam, this working 1 would have been your working 1 under required. I think I got it wrong. Yeah, just this must be required A, and this is required B. Okay, so remember, this working 1 over here would have actually been done under part A, because obviously starting with part A. So just be aware of that. So here we have from A, from B. So I'm not going to redo it. Okay, so remember in an exam, please also you don't go redo it. Just take note, if that part B is wrong, if this 1846 is wrong, we'd have calculated in this question, in an exam, you'd have calculated it over here. But based on how our classes worked, we calculated in part B. Now, you'd have calculated that number over here, and then you had to have carried it through into the next question. Now, remember, you must carry the same answer. They're going to give you the full marks. If you carry a different number, you're going to lose marks again. So just make sure you don't change something that must carry through from one question to another just because you realize you did it wrong. Carry through the wrong number because you're showing them that you know that number you calculated above is being used over here. Even if it is wrong, you're going to get your method marks. So please just be aware of that. Okay. Okay, so there we go. So that is, so therefore our total fixed costs so we get our total fixed costs, which is this over here. Okay, so now I can come equal to that, which is made up of working 1. So remember, like I told you, I'm only showing you that you you don't have to put in the fixed non-manufacturing costs. I'm only doing it here for our purposes. The reason being is so you know And that fixed cost is all fixed costs, manufacturing as well as non-manufacturing. Important to take note, it is also a total number. It is not a per unit number. Okay. Now we're going to do contribution margin per unit, and we want a weighted contribution margin per unit. So this is a good format to set up. You'll have details and you'll have your products. What's our products again? Charge, C, and smart C. Just have a total column. Not always going to use it, but sometimes you will. So remember, what do we want? We want total contribution margin. We want contribution margin per unit. What is contribution margin? Sales less total variable costs. Total variable cost is made up of variable production costs as well as variable non-production costs. Now over here, you need to ask yourself, how was the information provided? Okay, how you set this up is based on how the information was provided. But remember, what's the framework? You want contribution margin. Contribution margin is sales less total variable costs. Total variable cost is made up of a variable production costs and variable non-production costs. Now you ask yourself, okay, for production costs, how was it presented? For non-production costs, how was it presented? The non-production cost in this question is sales and admin, selling and admin. So we know that. Then, what was the other one now? Selling and admin. And then variable production, we know variable production is made up of direct material, direct labor, and variable manufacturing overheads. Okay, but we weren't given direct material, direct labor, and variable manufacturing overheads. We were given one balance called total production costs. But what do we know? That total production cost is based on the absorption costing method. So included in that production cost is fixed manufacturing overheads. We will have to strip out what relates to the fixed manufacturing overheads in order to get the variable production costs. So please make sure you understand that. First, start with the framework and then ask yourself, how was the information provided? Okay, so we know sales minus total variable costs. Total variable costs made up of two things, variable production and variable non-production. Variable manufacturing costs, variable non-manufacturing costs. In this scenario, it is selling and admin. Okay, so you can just put in the actual terminology, selling and admin. That's the actual terminology. Okay, you put in the proper words. Selling and admin. Okay, so now we can get sales. We want it on a what we want it on now? On a per unit level. So what is selling price per unit? I don't remember. Selling price per unit is what? So there we have actual sales, and we know the actual, so here's actual sales, and what do we know? That, so there's actual sales, and we divide by actual units, we will get actual selling price per unit. We know we want the budgeted 2018, we want budgeted 2020, but what do we know? Budgeted 2020 is actual increased by inflation. How do we know this is actual information? Because here they're saying, fortunately, the accountant emailed the 2019 actual financial profit statement. Okay, so now we know this is actual information. Everything over here is actual. We're using actual to calculate our budgeted 2020, because this is what they're telling you. The accountant was preparing the 2020 budget based on 2019 actuals. Okay, so just take note of those subtleties. So now we can work out selling price per unit. So let's have a look. So selling price per unit So remember, sales less total variable costs will give us contribution margin. This will give us contribution margin per unit. But what do we want? We want a weighted contribution. So the way we're going to do it, we will determine a sales mix. So we'll say sales mix. The sales mix will give us a weighting. So we will use the weighting. We will use the weighting to get to our weighted contribution margin. So this will give us a weighted contribution margin per unit. Okay, so that is the setup. Now we can work out whatever we need. We need working 3, which is sales per unit. Okay, so here I can just say actual sales 2019. Actual sales 2019 was, let's have a look. Actual sales 2019, 4860. I just really want to see if I used full numbers over here. Yeah, I used full numbers. So this here is 4860,123. This was, what was this now? 5805, 5805, 123. Okay. Actual sales units 2019. What was it? This was 243. This one was 129. Just confirm for me. 129. So here we have sales per unit. Just make sure that actual unit is right that I have. And this is sales per unit, which is basically 486 divided by 243. Okay, and now we will have the increase percentage, which was inflation. If I remember, inflation is 6%. 6%. So therefore, budgeted sales 2020 budgeted sales 2020 is whatever that answer is. Just make sure that the numbers I'm using is correct. I'm just trying to remember what I remember. So budgeted sales 2020. Budgeted sales 2020. So this is going to equal, remember when you apply growth rate, you say that multiplied by 1 plus the growth rate. Okay, the growth rate is inflation. So that is our sales price. Okay, so now I can go plug this in, sales per unit. $21,200, and that I can tell them where I got it from. Working 3. Working 3. Okay, brilliant. Now, admin. Remember they told us selling an admin is 5% of revenue. All I can do is say that multiplied by 5%. So nothing to worry about. I mean, we can make it negative also. Because I mean, that's how we're going to write it in the exam. Now, all we need to do is get our variable production cost. I think I have it somewhere. Let's go check in the previous question. Now we get the variable production cost. I think I did it over here. Let's just see what's over here. Okay, now, so let's work it out. So we want variable production costs per unit. Okay, so we want variable production costs per unit. So working for, oh, sorry, this comes from, where did this come from? Oh, we're just going to say sales times 5%. Okay, nothing. You know, we don't do working for everything, but just explain to them. UNISA wants you to tell them where you get stuff, but there's no need to work out everything. Okay. Well, I hope it's not. By just saying sales times 5% should be sufficient. Okay, so working for, we want production costs, or not production, we want variable production costs. Okay, so what we can do, one variable production costs per unit. So what we can do, this over here is our total production costs. Okay, so we can use our total production costs, and then we can get the production costs per unit. Okay, so let's quickly have a look. So if I go back, so just help me with the numbers 3510, 5063. Okay, so total production costs 2019. What was the number again? 3510, 3510, 123. What was the other one? 5063.
Yes.
5063, 123. Okay. So that is total production cost. But what do I want? Production costs per unit. So I'm going to say units produced 2019. So I'm going to go fetch this from required B. Okay, so I remember doing this calculation. I'm going to say somewhere we calculated it. So units produced 2019, there we go. So it's from B. So this is production costs per unit. So if I do that, this gives me production costs per unit. Now, I don't want production cost per unit. I want variable production cost per unit. The question I need to ask myself is that variable production cost per unit? And the answer is no. How do I know that? Because they're using the absorption costing system. How do I know they're using the absorption costing system? Because the income statement they provided us has gross profit. So that's why I know they're using absorption costing method, and therefore production cost includes fixed manufacturing overheads. Now, I don't want a production cost including fixed manufacturing overheads. I want a production cost excluding fixed manufacturing overheads. Why? Because I want variable production costs. So at this point, I know this is not the actual number I want, because that is not variable production. This is production costs. This is total production costs per unit, which is which includes fixed manufacturing overheads. So all I'm going to do, I'm going to get fixed manufacturing overheads per unit. So now I'm going to say fixed manufacturing overheads per unit. Okay, so I can get this from B as well. So somewhere in B, so remember, if we have a look over here in point 4, they said fixed manufacturing overheads are currently allocated based on labor hours. Fixed manufacturing overheads are currently allocated based on labor hours. Historically, the production cost processed required 4 labor hours for charge C and 8 labor hours for smart C, calculated at 750 Rand per labor hour. Okay, so we can go work it out. So therefore, fixed manufacturing overheads per unit, is for charge C, it's 4 labor hours multiplied by 750 Rand per labor hour. And then over here, it is 8 labor hours multiplied by 750 Rand per labor hour. Okay, so I'm just going to say here, number of hours, number of labor hours per unit multiplied by 750 Rand per hour. Okay, so that is basically, so you just know how we got that number. Somewhere it is calculated somewhere, just can't seem to find where. Now this is going to give us variable production costs. Now this is going to give us actual variable production costs per unit for 2019. Okay. So it's going to be 13 minus whatever that is, and there we go. But we don't want variable production costs for 2019. We want variable production costs for 2020. So there's going to be an increase rate that they told us, increase rate. The increase rate that said, they said 2020's variable production is going to increase by 5%. So therefore, variable production variable production (2020) is going to be the increased amount. How we work out an increase? The previous amount multiplied by 1 plus the growth rate or the increase rate, which is that. So there we go. So this here is C41, and that's from working 4. So when I come over here, it's equal to C41. I'm going to make it negative C41, and that will be D41, and that will be from working 4. Okay, then we're going to say, so now we have contribution margin per unit. Contribution margin per unit is the sum. Remember, sales less variable costs. So contribution margin per unit is 9 whatever, and over there it is 16,000. Now we're going to get our sales mix. The way we're going to get our sales mix is as follows. We get so we're going to get whatever the sales. So we're using budget information for 2020. So what is the budgeted sales for 2020? It is actual sales of 2019, 243 and 129. Okay, so that is the right numbers, right? So now I can get a total. So the weighting is basically charge C as a percentage of total sales and smart C as a percentage of total sales. This is going to have to add up to 1 as expected. Okay. This must add up to 1 as expected. So the weighted contribution is simply going to be contribution margin minus the weighting of charge C, and once again over there, contribution margin of smart C multiplied by its weighting. Okay, so the total weighted contribution is the sum. So that's the number we're going to use, the sum. So if I go over here, my weighted contribution, I'll tell them they can have a look at working 2. So I'll tell them they can go look at working 2. And now I have break even. Break even is total fixed costs divided by weighted contribution margin per unit. So that means I need to sell 155 units. Okay. Now remember, you can't sell a 0.12 of a couch. You have to sell a full couch. But what we do is we don't round up here. We will round up once we do the split. So the way we do the split is we go fetch the sales mix. The sales mix of charge C is what we calculated over there. The sales mix of smart C is what we calculated over there. You just go fetch it. So the final answer is going to be total break. So that's a total break even number of units. But of that, 65% needs to be charge C. And of the 155, 35% must be smart C. So that is the break even. Okay, so in break even units per unit, you first get the total break even, then you multiply it by the relative weighting in order to know how much of each product needs to be sold in order to break even. But now we come at this point. You need to sell 101.33 charge C units. You can't sell 0.33. So you need to make a call. Are you going to sell 101 or are you going to sell 102? If you sell 101, you're not going to break even. So because it's less than 101.33. So therefore you have to go with 102. Similarly, if you with 53.79, you can't sell 0.79 of a smart C couch. If you sell 53, you're not going to break even because 53 is less than 53.79. So therefore it's going to have to be 54 units. So that is the final answer. So to conclude, you will just say to break even. Who's this company now? What's their name? What's the company's name? SSI. SSI must sell 102 units of charge C and 54 units of, what's the other one? Smart C. Okay, so these, we should get 100%, I presume. I don't know, you can check. So that's the answer. Well, at least in my mind, that's the answer. You can check the solution. If you find mistakes, just let me know. But I'll check the solution sometime. I didn't check it yet. Do you guys have any questions? Ashita, Bernice, Faid.
No questions.
Faid.
No questions.
No questions.
Okay, Fakir.
No questions.
Ryan.
No questions.
Okay. So tell me, what is still confusing? I'll give you 1 minute to think, 30 seconds to think, and then tell me what you find confusing. What is still confusing on your side? Ashita, anything confusing your side? Bernice?
I don't think there's anything confusing on my side, but I would like to add that for me, it's just really just getting to think like this process, because you make it look so easy. But I promise you, if I would have done this the first time, I would have not gotten anything like this.
Yeah,
so I think it's just developing that mind way of thinking.
So, so what we're going to do is I'm going to give you homework. There's another question similar to this. So I'm going to give you guys homework, and then you will submit it to me. Then I'm going to have a look at it. I mean, I'm not going to like go into detail. I'm going to look quick through it, and then I'll provide you guys with some feedback. Okay. Ashita, Bernice, Faid, anything confusing your side?
No, not at the moment. I must work through this stuff.
Okay. Ryan?
No, not at the moment. I just think practice going over this question again. It might seem easy, but I need to do it on my own.
Okay.
And see how I actually do in the question.
Bernice, anything your side?
It's not confusing, nothing confusing. I agree with the others.
Okay, so you need to practice though. Okay, so I'll tomorrow morning I'll tell you which question you must do by the weekend. Okay. Fakir?
Nothing so far. Just have to redo this question, but nothing so far.
So, like, I'm pretty sure when I was going through the questions, I just can't remember the certain. I went through a few questions. I think the other question I selected is basically exactly this. When I say exactly the same, I mean they ask you for break even, and it's also going to be a weighted break even because it's more than one product. Now, it's not always going to have activity-based costing, but there will be either absorption or variable costing. You see what they did over here? Why they asked part B for absorption? because basically you're doing contribution margin, which is a variable costing principles. So therefore, you can, if you just pick up that trend, it will generally be like that. Because so to test 4, you cover your allocations, your cost allocations, and your costing systems. So remember, your allocations is the additional costing, ABC. Your costing systems is what was it now? Is so your costing systems is, what is this? Tell me quickly. Variable costing, absorption costing, and then they cover process costing, job costing, joint costing. So we must cover joint costing question. Don't stress about process costing. Process costing won't be tested like it tested in undergrad. The reason being is, if you read the PSYCA guidelines, PSYCA don't want you to do process costing. PSYCA wants process costing to come through because they require you as an ultimate chartered accountant and as a newly qualified chartered accountant to understand the principle, one of the key principles of process costing. And basically the ultimate principle of process costing is something known as an equivalent unit. So they test equivalent unit without even realizing. Okay, so you might just know the concept of equivalent unit when it comes to process costing. That is on a CTA level. They're not going to test you on process costing, so don't waste your time. Okay, so we might just cover still a joint costing. And then, as you can see, will be CVP. So these are the typical things that you will be encountering. So I'm looking for a CTA joint costing. If I don't find, I'm just going to use one of the MAC4761 joint costing questions. Nasreen, do you have any questions? Anything confusing your side?
No, I agree with the others. I think once you start working to the example yourself, then you realize what's confusing you.
Okay.
So I'll reach out at that point if I have any issues.
No problem. I just want to see Tandy made a relevant point somewhere here. Yes, so that per unit versus total cost, very, very important, right? You must distinguish between per unit versus total. You must also distinguish between budgeted versus actual. Don't get messed up over there. So like I said, that will guide you where to look for information, whether it's budgeted, whether it's actual, whether it's 2020, whether it's 2019, whether it is May, whether it is June, whether it's a full year, whether it's 1 month, whether it's a quarter. That will guide you because they have headings for the relevant information. Like for example, over here, in another scenario, using the same information, they could have said budgeted 2019, budgeted to actual 2019, budgeted 2020. So when you read information, you just go to that section. Like I said, most likely 95% of the information will be under that section. The other 5% maybe will be elsewhere. In most cases, all the information will be under that section, but there are cases where a small amount is elsewhere. You understand? So make sure you read your required carefully, because that will guide you what to do. Okay. So I'll stop there. Just so you know that I sent out meeting requests with the links, with the Zoom links. So tomorrow, as per normal, is FAQ 1, FAQ 3, Wednesday, FAQ 2, FAQ 4. Then you can choose if you want to join or not, but basically on Thursday and on Friday, I'm running additional FAQ classes. So that is Thursdays can be FAQ 1, FAQ 3, so you can do more impairments. Remember, I had 3 impairment questions that I showed. I want to cover all 3 with you because your key information, key principles that is different for each one. So I want to make sure I cover it with you. So on Thursday, we'll cover the other fact. Tomorrow, we will finish off the fact of last week, the question of last week. But on Thursday, we will cover another FAQ 1, FAQ 3 question. Then on Friday, we'll do another FAQ 2. So last week for FAQ 2, we did IFRS 9 to sub. this tomorrow, I'm going to choose a question that is going to be sub to sub, right? Whether it's big or small, okay? Because it will be the same thinking, exactly the same thinking will be applied. I'll just show you the slight difference that may occur. And then on Friday, I'm going to do a IFRS 9 to sub, a sub to an IFRS 9. That is the challenging one. Okay, so if you want to join those extra two classes, then you can join. Then you'd see I've sent out email requests with the links for next week. Next week, Monday to Friday, is going to be test revision. Okay, for test 3. So Monday and Tuesday is MAC. Wednesday is the 16th of June, which is a public holiday. So we're going to run 2 sessions, early in the morning and mid-afternoon. So I think 12:30. So I think we run from 9 till 11. Then I give you a 1.5 hour break, and then we come back 12:30 till 2:30. Okay. So then we're doing FAC 1 on that day. I'll select a question. I'll send the question before the time. So that was one of the requests for some of the students. And then Thursday and Friday would be FAC 2, FAC 4 revision. Okay, so just be aware that is the schedule up until what you call it. So I'm giving more lessons for the FACs because that tend to be the more challenging ones. So FAC 1, FAC 3 in terms of results, that is the challenging one. So given that this is impairment and PPE, there's not a lot of topics. And so we can use this to boost our mark, but impairment is not easy. So as I'm doing more, what you call, so you can see the different scenarios, same principles, but there's slight changes that will change the way you do the impairment, allocation. So I'm going to do all 3 with you. And but I'm still going to give you some homework. And then for groups, change in ownership tends to be a challenging area. So I want to do the 4 scenarios so that I can show you that it is not as complicated as your mind perceives it to be. Okay, so that's it. For MAC, it's only this. So I'm going to give you some homework. If you want an extra class, we can see how we can arrange 1 extra class over a weekend, but I don't plan on having the extra class for MAC because I think MAC is doing quite okay, and it's not there's not a lot of topics for this this test. Okay, so that's it from my side. If you have any questions, just let me know. I will, by tomorrow morning, I'm going to send you this recording, and I'll also send you the homework for MAC. And remember the workbook is on Google Drive, the MAC folder. There's only one because I did last week and this week in the same workbook because we did the same exam question paper or test question paper. Okay, that's all from my side, guys. Have a good evening, and all the best for the studying for the rest of the week. Okay, bye-bye. So no other questions, eh? Okay, cool, bye.